As I was saying, global growth is bouncing back as reflected in corporate earning growth, but it is uneven. Countries impacted by geopolitics and lower oil prices are showing lower growth. Countries riding on the AI investment and AI spending are showing higher growth. Inflation is well above central bank target. Globally, most central banks are well below their inflation target. Even Japan is raising interest rates after decades of low interest rate to contain inflation. Courtesy rising inflation, borrowing costs have started going up for government securities across the globe, including G7, and today they are well above COVID peak. The US-Iran-Israel conflict is coming on back foot. Number of ships passing through Hormuz has increased. But as we speak, Bloomberg is showing a headline where a LNG tanker from Qatar was attacked by a projectile while passing Hormuz Strait. Overall, with the oil prices coming down and oil supply increasing, expectation is that global economic growth will recover. A large part of this growth is driven by semiconductor and AI-related investment. If we look at stock price performance of all world indices without semiconductor stocks, then there is a massive drop in the performance. Obviously, what goes up needs to come down. And we have seen in the past how what performed well year before last came crashing down in this year, whether it was crypto or software stocks or consumer companies or defense company or China internet companies. What ran ahead of their fundamentals came crashing down this year. Crypto in particular has been fairly stark. Normally, uncertain, volatile environment should support crypto prices. But this year, cryptos led by Bitcoin has corrected significantly. Coming to Chinese economy, the surprising part of China has been sharp reduction in import of crude that has allowed crude prices to come down. China is a manufacturer to the world, and their market share in volume of various product category is truly astounding. More than 315 categories, they have more than 50% of global production, and it has seen sharp increases post-COVID. When US put tariff on China, it routed their exports via Asian countries like Vietnam, Thailand. It ensured that China's export juggernaut continued to roll. China is also efficient vis-a-vis AI investment. How much of this is real and how much of this is creative accounting, we don't know. But at least on paper, AI-related capex from major companies in China versus US is vastly different. To some extent, Chinese competitiveness is coming because of subsidies given by the government, whether it is in terms of free land acquisition or tax concession or lower interest rates, grants and subsidies. But combined, China spends far more on subsidies to support manufacturing than rest of the world. China pursues growth at any cost, and which is why their listed companies haven't shown as much profit growth as probably would have expected with the growth. Chinese market even today trades where it was 17 years before, reflecting this profitless growth. If companies are not making profit, undoubtedly it becomes difficult to provide higher salaries and wages. And compared to rest of the world, Chinese wages have grown at a much muted pace. Obviously, this is reflected into stress on consumer loans, whether it's credit card or mortgages. NPL levels have started increasing over there, and consumption continues to remain subdued in China. Coming to US economy, there has been significant rebound in DXY, the trade weighted dollar index. It is back above 100 despite the ongoing war. This is primarily driven by their AI related investments. American stock market has outperformed globally over last one and a half year. This is also driven by companies like Microsoft and Nvidia. Their earnings are likely to be ahead of entire listed India's corporate earning in calendar year 2026. Look at the growth in Nvidia's profit in CY22, about $10 billion, 2 years down the line, $30 billion, and now almost $200 billion. It's a growth of more than 20 times in just last 4 years. This market also supports companies like SpaceX. It came out with world's largest IPO at more than $84 billion, and straightway it got listed at close to $3 trillion market capitalization. Undoubtedly, Americans are seeing this wealth courtesy growth in equity market, and they are saving less, and yet they are becoming richer. There is also massive flows coming into American stock market, both from local resources as well as global resources, driven by lure of their market. On top of it, American companies generating so much of cash spends a lot of money on buybacks. Consequently, for years and years, net equity supply in American market is negative. That means buybacks are more than the IPOs. While American economy continues to remain largest and most innovative across the globe, it also carries a burden of almost $40 trillion. Those debt as a percentage of GDP, as debt servicing cost continues to rise, and people believe that US is reaching unsustainable debt burden. This higher risk is reflected into American government securities yield, and this is not yet reflected into American securities. Their yield continues to remain flat, whereas globally other countries' yields have gone up. This is also one of the rare period where wage increases are less than price increases. That means American households will get impacted by higher inflation. Inflation is remaining above Fed's target rate of 2% for last almost 5 years. AI capex is almost 80% of US incremental GDP growth driven by investment. But large part of AI investment is through imported equipments, mainly chips from Taiwan, Korea. Till now, AI was funded by cash flow by profit. Now it is expected that bond market will provide a substantial share of funding. In fact, equity will be roughly about $1.5 trillion and debt will be balanced $3.5 trillion to fund $5 trillion of requirement. While every company is rushing in to invest in AI related infrastructure, from data centers to GPUs to cables, one doesn't know whether AI investment is providing return on investment or not. Token volumes have grown substantially across the globe. Prices have more or less remained flat over last year or so. And some of the lower price models like DeepSeek are seeing far more volume compared to, let's say, some of the tokens which are expensive. At one point of time, there were 7 stocks which were delivering great return and they were called Mag 7. Now today, except Google and Nvidia, other stocks have started underperforming S&P 500. Coming to Indian economy, we did suffer in the first quarter because of geopolitical crisis. Both availability of oil as well as price of oil was adverse for Indian growth. Now that concern has been replaced by monsoon. In the month of June, we had more than 40% deficit as a country. Thanks to rains in last 1 week, that has come down to roughly about 23%. But yet there is a shortfall of almost 27%. The biggest shortfall is in central India, where almost 59% lesser rains has been received. South is relatively okay. The water reservoir level had dipped remarkably in the month of June. Hopefully July should see some amount of increases. The expectation of monsoon for July, August and September is well below long-term average. El Nino is likely to impact monsoon in the rest of the July, August and September. Whenever monsoon deficit is more than 10%, agriculture output reduces, agriculture GDP gets adversely impacted. Partly due to geopolitical crisis and now because of lower monsoon, some of the indicators are showing slowdown in momentum. This chart shows out of 100 odd indicators, how many indicators are still positive, and compared to last quarter, we have seen a reasonable drop. Obviously, the expectation is of recovery, courtesy oil prices coming down. However, monsoon and El Nino continues to remain a concern for the growth. Some of the positives of last quarter: a BOP surplus came in a BOP surplus is expected in FY27, courtesy capital account flows as FPI intensity comes down, and the steps taken by RBI like FCNRB deposit brings more dollar flows. Undoubtedly, US-Israel-Iran conflict cast its shadow on our fiscal balances. There was excise duty cut which has hit by about 1,70,000 crore. Fertilizer subsidy for this year is expected to grow by 1 lakh crore above budget estimate. LPG subsidy 60,000 crore. There could be shortfall in personal income tax collection of about 76,000 crore. And total shortfall because of geopolitical crisis could be 4,30,000 crore. How is this likely to be funded? Some GST collections are growing above budgeted estimate. Custom duty collection is likely to be higher because of higher oil prices and increase in gold silver import duty. Some relief in corporate tax and dividend tax. Some cut in the capital expenditure, and some cut in the revenue and state transfer. Overall, we will achieve our budgeted deficit number or exceed it marginally, but that's because there will be significant cut in both revenue and capex by cutting down on spending. The fiscal deficit, both at the center and state level, comes under pressure because of geopolitical crisis and below average monsoon. This needs to be supported by revival in private investment. Companies are sitting on cash and much lower leverage. Banking credit should be available with FCNRB issuances. And if private capex takes off, then to some extent, adverse impact on growth will be reduced. The manufacturing in India has continued to remain fairly resilient despite geopolitical shock. Our electronic production of mobile phones and component has gone up. Defense, indigenization, as well as export is increasing. There are many sectors where we have increased our share in global manufacturing, from cement to steel to aluminium. We have increased our global share, and smartphone is one of our success story. So manufacturing has definitely improved. The external vulnerability has come down as oil intensity of our economy has come down over the years. Focus on renewable energy is also helping reduce oil intensity. India has one of the largest electrification in the world. And more importantly, terms of trade have also changed in India's favor. So manufacturing is resilient. External balances are under control. Despite this, Indian currency has depreciated against most of the other currencies. And this depreciation to some extent gives edge to Indian exports. Compared to Australia, South Africa, France, we are down more than 15%, and this should help our exports. On a real effective exchange rate basis, India is now below Chinese yuan first time since April 23. That hopefully should help reduce imports from China into India and encourage local manufacturing. India is also entering into free trade agreements. European agreement should be up next year. Hopefully, all these free trade agreements will also support our exports. Put together, this free trade agreement should help increase exports by about $50 billion. European Union will contribute significantly over there. Let's hope and pray that between Europe and US, India increases its exports. The rupee was volatile last quarter. RBI took several steps to improve dollar flows, FCNRB issuances, investments by overseas investors, external commercial borrowing, limit liberalization. Put together, we believe rupee should get $50 to $75 billion of flows over next 3 to 6 months. That flows between ECB, FCNRB, and debt FPI flows should bring balance of payment surplus after 2 years gap in FY27. This will also create credit multiplier effect in the economy as banks deposit growth recovers, and that should support growth in the days to come. Our challenge continues to remain on how do we capture opportunities in AI sector. Now, on the semiconductor chip side, Tata Crompton CG Power and Micron, these three facilities are coming up. Some have started production. Hopefully, India has entered the race on the chip side. On the GPU side, we don't have a play. On the frameworks and cloud, again, we have limited play. On the models, Servam is there, but nothing comparable to what is there globally. Our opportunity remains in applications where we use LLMs of other countries and develop applications which can be used by the globe. Converting this into equity markets, India is one of the worst performing equity market in dollar terms over last 12 months. The FII outflows have been relentless, especially since global crisis began. March saw about $14 billion outflow. April, May were almost $5 billion. June intensity has come down, and occasionally we have seen FPIs buying in the month of July. The selling was driven more by emerging market fund. They have become now neutral to underweight on India. Even Asia dedicated funds are also underweight India. The FPI selling has been far more in some of the large names like banks, IT companies, and FMCG company. Collectively, their holdings are down significantly. They were almost 40% of FPI portfolios in India. Today, they are down by close to 50%. However, FPIs have continued to increase their holding in small and mid cap. There are almost 400 stocks which have been added since COVID in FPI buying list. While FPIs have bought small and mid cap, large cap they continue to sell, and consequently their overall ownership of Indian equity has come down to 14.6%. The quarterly results for March 26 quarter has been fairly robust. 26 company Nifty outperformed expectation, 15 missed. In the mid cap 100, 41 outperformed and 23 missed. In small cap 100, out of the results declared so far, 34 outperformed and 29 underperformed. The earnings growth in mid cap came ahead of expectation, 32% growth. The small cap growth came at about 15%, and large cap growth came at about 9%. This earnings growth has ensured that small and mid cap as a percentage of total market cap continues to increase, whereas large cap as a percentage of total market cap continues to decline. From somewhere around 75% of market cap in top 100 companies, today the number has come down to about 58%. New issuances as well as rapid price rise in small and mid cap stocks have created this situation. The domestic institutional investors, thanks to your support, has been regular buyer. The primary market has seen flows from FPI. There's not even a single IPO in which Kotak Mutual Fund wanted to invest, and we didn't face competition from the FPIs. FPIs are selling in secondary market but buying in primary market. Our valuations have now reached around fair value. Market cap to GDP ratio looks higher on a historical average, but it is in line with global averages at this point of time. The large cap valuation is somewhere around its historical average. Historical PE is about 18.7, large cap is at about 18.4. The small cap is trading at a premium 17.3 average, currently at 22 times. Mid cap is trading at a slightly higher premium because of superior earnings growth. Mid cap average was about 24, and the current mid cap is trading at about 28. Small and mid cap trades at a slight premium to historical average, but can be justified based on the shift in B2B companies to B2C companies. If we see sectorally, private banks continue to trade well below its historical average, and retail also trades below its historical average, whereas auto is trading somewhere around its historical average, just like the chemicals and healthcare. Capital goods trade at a premium to its historical average. IPO supply is likely to continue in FY27. NSE Geo platform, two large issuances are likely to hit market in the days to come. This supply of paper is likely to cap the upside of the market. Is AI trade reaching a bubble? God knows, but these are the two funny incidences. There was a company called Louis May. It's a snake company, but it got listed as LLM ticker, and people thought it must be AI related stock based on the ticker, and it went up 186% on debut. In Taiwan as well as Korea, we have seen locals redeeming their insurance policy or borrowing on the same to invest in stock market. Typically, when such kind of behavior occurs, market top is likely to happen. If we look at India's case, well, unlike Taiwan, Korea, which is concentrated on few companies or few sectors, we are fairly well diversified. You can get financials, IT, industrial, consumer discretionary, and so many other sectors. Unlike Taiwan, where 88% of market cap is IT, or Korea, where 61% of market cap is IT. Our call, like last month, continues to remain equal weight to equities. But since April, we have been saying that investors who have aggressive risk profile should become overweight on equity. Large cap continues to remain equal weight, mid cap thanks to superior earnings growth overweight, and small cap because of the valuation slightly underweight. From an equity investment point of view, other than Kotak small cap fund, across almost all our equity funds, we have outperformed benchmark indices over last 3, 5, 7, and 10 year. This is on a point-to-point basis. Same is the case in our equity and hybrid schemes. This is on the SIP side, bearing small cap. All our SIP in our funds have outperformed their benchmark indices across equity and hybrid fund. This is on a rolling return basis, where even small cap and all other funds we have outperformed our benchmark indices. Kotak Flexi Cap Fund continues to remain one of the tortoise of the race. It runs slowly, but it continues to deliver. It has outperformed benchmark return consistently. Multi-cap again has delivered fantastic outperformance. Multi-asset allocation fund takes care of your responsibility of dividing client money across debt, equity, and gold and silver. Multi-asset Omni Fund of Fund has almost 18 years plus of track record. And as you can see the numbers, it's been consistently outperforming benchmark indices. Coming to fixed income market, US inflation continues to remain well above Fed's target rate. From expecting interest rate cut by US Fed couple of months back, now market is pricing in rate hikes. Despite appointing US President's nominee as chairman, Fed has given signal to the market that it will look to raise rates rather than cut it. As US-Iran conflict started easing off, rupee got supported as oil prices came down to 60-70 handle. The debt investment by FPI in gilt was given tax exemption. They were exempted from paying withholding tax in India. That resulted into 40,000 crore worth of flows coming to Indian debt market last month. Our inflation has moved up on a consumer price side, but the core inflation is remarkably stable and both continue to remain below RBI's midpoint range on inflation. The RBI has revised its growth projection and increased its inflation projection a bit to reflect current situation. RBI continues to manage liquidity and it should get supported by FCNRB issuance. At this point of time, RBI came out strongly in indicating that no rate hikes are planned. This should support the fixed income market for the time. On the debt, apart from short-term funds, one fund for customers is Income Plus Arbitrage Omni Fund of Fund. It puts about 35% in equity arbitrage fund and 65% across the yield curve. Put together, after 2 years investment, gains from this fund will be taxed at 12.5% for long-term capital gain. Gold, after almost 4 years of positive return, has gone into negative territory. Silver, after last year's blockbuster year, has gone into negative territory. Gold prices have corrected from almost $5,000 to below $4,000 and now recovered to touch $4,100. This consolidation is gold driven by long rally since 2022. Plus, it also got impacted by US Fed expectation changing from rate cut to rate hike. Consequently, falling prices also resulted into gold ETF holders selling their holdings. It happened in US as well as in India. The long-term price movement of gold seems to be deviating from the global liquidity curve as governments across the globe tried tightening of liquidity. This probably has resulted into such diversion. Central banks buying of gold was one of the primary driver of gold movement. And we kept on saying, if central banks buy, you buy gold. Central banks sell gold, you sell gold. If central banks don't do anything, you don't do anything. In the month of May, central banks have continued to buy. A survey done by by World Gold Council also indicated that 45% of central banks are looking to increase their holding of gold. And this gives us confidence to say, despite recent underperformance, gold is an asset class to own. Gold typically has moved in step and ladder. There are periods when it does well, then it corrects, and then again it starts doing well. Silver continues to remain a trading call. It has corrected significantly from $125 high to current $60 odd level. But since there is increase in supply, including recycle, silver prices continue to remain volatile. If I have to summarize, These are some of the products which you need to keep in mind apart from mutual fund. One is a special investment fund. These are product aims at reducing volatility and increasing risk adjusted return. SIF has long only as well as long short and leverage options. Typically, they are launched on hybrid or equity SIF platform. Managing SIF obviously requires special skill and talent. We have recruited Kalpesh Jain, who will be managing our SIF under the supervision of Harsha. One can start small and build on experience. Our maiden NFO of hybrid SIF collected about 500 crore, and there is more in the pipeline as people see performance. Performing credit AIF requires minimum 1 crore investment. It's close-ended funds, and it's of debt as well as equity oriented from a risk return point of view. And AIF is something which one should consider because it is allowing investors to participate in that market which otherwise is not available in mutual fund, insurance, pension fund, or bank. Today, when promoters wants to borrow money for adjusting their cash flow, they require AIF market. Deals are many, borrowers are more, supply is less. Deal structuring happens reasonably good. There could be delays, but unlikely to be default in performing credit AIF market. REIT InvIT, they are convenient way to take exposure of real estate or infrastructure projects in your portfolio. They are available in secondary market. Global funds are available via GIFT City LRS. And finally, if you are using LRS, do consider investment in global gold ETFs. Sell gold in India and put that money via LRS into global gold ETF. You will get 15% to 18.45% extra gold, a much better trade in today's market. This is the most important slide of our presentation. This shows our call on asset class, on market capitalization, on sector, and which are the top 3 recommendation of funds in our portfolio. Our passive portfolio continues to grow, and we are one of the lowest expenses fund on the passive category. It's a conscious decision where we would love to remain in the lower decile of expense ratio for the passive funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.